So 2018 looks to be a fascinating year for investors. Clearly we've already seen a significant rise in volatility across markets. I think we know that interest rates globally are rising. That's very different to what's happening in the Australian context. So we fully expect that the United States will continue to raise interest rates over the course of the year. For Australian investors, that has big implications. Every time that they raise interest rates, we've seen out-of-cycle mortgage rate hikes in Australia. And that tightens financial conditions on those that are least able to afford it. We know that parts of the complex of the inflation complex are actually quite inflationary in Australia. So there's a fast five of tobacco, which is arguably should be on the rise and it's regulated to rise, and that's a good thing. But fuel, utilities, health, education, things that people critically need are getting more expensive. That's running at 7.5% in 2017. Aside from that, there is very little inflationary impulse. So we just don't see any need for the RBA to move. And the RBA have been highly explicit about the fact that they are not in any hurry to do anything with interest rates in Australia. They never went down the rabbit hole that other central banks went down in going to emergency rate settings of 0 or quantitative easing. And as a result, they don't have anything to take back. So we see it as being a fairly benign year in terms of interest rate movement for Australia, which makes bonds highly investable and certainly a critical allocation in terms of defending portfolios and lowering portfolio volatility. Having that capital preservation and that income guaranteed by governments is going to be critical as the year plays out, particularly as we're expecting a somewhat volatile, riskier part of the asset market. Once that volatility comes out of the bottle, it's very difficult to put the genie back in. And we know that with interest rates moving globally, that's lifting the global cost of capital. Now, this has been the precursor to every recession we've had in the last 50 years. It's not happening tomorrow, but it is on the horizon and something that investors need to think about. A lot of the strategies that have worked really well over the last 9 or 10 years are unlikely to work well as we go into this change period. They may very well work well on the way out, but they're probably going to reprice and recalibrate. So as that volatility rises, investors need to be very conscious of that, think about what their liquidity requirements are, and if they have liquidity requirements, can they get through the market quickly? The great thing about a sovereign allocation or the like, it's open every day, even in the GFC, where a lot of other funds were gated and closed. These products were never closed. They are highly, highly liquid, the most liquid you can find. And so in terms of providing income and giving people that capital surety, plus lowering their market volatility, we see it as a good news story for investors. It's a very credible defensive alternative, and it probably comes into its own over 2018 as other assets become more and more risky and volatile.